Hi, I'm Scott from Solace Financial, and this is a market update for my clients, friends and family. None of the information in this video is personal advice. Please give me a call before doing anything. Our market since last video is down 6%, which is not too bad. It's a fairly normal movement in the market. The election really hasn't affected it at all. And if I look back in history and I look at how Labor or the LNP affect the market, and it really isn't that much. We're talking -1% to maybe positive 0.5%. So not too much in the market there. For the last 12 months, our market's only down 1.5%. So again, not too bad, a bit of a bumpy ride throughout the year, but again, fairly normal volatility in there. What's unusual at the moment is the bond market again. So last month I talked about and gave a crash course on how bonds work. Well, this is now putting that into practice as we're seeing large movements in yields. Now, this is all due to inflation worries and pressure on the Reserve Bank's interest rates going up, and we're starting to see bond yields go up. So loans to different companies a lot higher in interest that we can get now than before. Why is this important? Well, for most retirees, about 40% of their superannuation fund is in bonds. And in the last 12 months, a normal indexed bond fund, so one with fairly longer duration, I've seen returns of -20% in the last 12 months for some of these. So if you're a retiree in a balanced fund, then this is about 40% of your portfolio, or could be. Now for us at Solace, we've had low duration, which has meant that we haven't had negative returns in our bonds, but they are very low returns. They're close to zero, which for the year is a pretty good outcome. So what we've seen is interest rates on bonds go up. So you can see in this chart here that someone like the Queensland Treasury, if we took out, or if we started up a 2-year bond in January of this year, so the term of the bond is for 2 years, we could only get about 1%. Now in May, we can get close to, we can get 2.8% in a 2-year bond, which is close to a 200% kind of increase in yield, okay, or interest rate. For someone like Macquarie Bank, which you would say is a really safe company and safe bond, in January we could only get about 1.7%, but now we're getting close to 4%. And if we went down the risk scale a little bit, and you could see that Santos, in January, we could only get 3%. So if we lent money to Santos, they would pay us 3% interest for 2 years. Now we're getting close to 5%. And that's really important for clients' portfolios. And we are making changes to clients' portfolios at the moment and taking a little bit longer duration, locking in some of those good fixed income returns or bond yields for about 2 years. So you may see some changes in some of your portfolios over the coming weeks where we're starting to change the fixed interest. We're also just reducing slightly some Australian shares. We still think that there's going to be some volatility in the market, and we're looking at the returns that we're seeing on bond yields, and we're seeing opportunity there to pick up, your 4 to 5% in interest, plus potentially any capital value if yields don't go that high or rates don't go that high, which we don't think that they will. We've also recently put some gold in some portfolios and a lot of portfolios there. It depends on what your super and investment funds are, whether they allow that or not. If you've got any questions about exactly what we've done and why, or if you want to talk about bond yields, please give me a call or send me an email. Thanks very much for your time.